Okay, welcome back to Rockstock Channel. It is Tuesday, September 26th, and a great privilege to have Dale Henderson, the CEO of Pilbara Minerals, on for the second time. We've had Ken Brinsden on a few other times, but it was almost exactly a little bit more than 12 months ago, the end of August. You joined us when you recently had just joined as CEO for Pilbara, Dale. So I think it's timely to get an update with the market, pricing going down quite a bit, but you just had your annual results. You paid a nice big fat dividend, contrary to my suggesting last year that you hold off on giving dividends, but I don't know if you anticipated as much cash flow. So you have a combination of those things. Before we start today's video, we'd like to thank our two sponsors, Brine Field Services Company Zelandez and investor Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more about these sponsors later in the video. But I want to start just for viewers who are maybe not familiar with Pilbara, because we often assume, our listeners have more knowledge about the industry than they might. So I just want to talk a bit about the journey of Pilbara from 2015, 2016, when I first started paying attention, and we're going to put up a stock chart, from that point, until today, and obviously went through some difficult period in the 2018, 19, 20 period, and have recovered greatly. And I compare that to what I witnessed in iron ore. Like, I've been doing this for a long time, 20 years in the resource space. I did a lot of work in iron ore and in Western Australia. You worked for Fortescue chart for a long period of time, looked similar to Pilbara's chart. They have a 20-year history. But Pilbara, I've called you the new force in lithium, called Pilbara the new force in lithium. Fortescue was the new force in iron ore. Today, Fortescue is, a 61 billion Aussie market cap. They've paid hefty dividends along the way. They're currently at an 8% dividend yield. Pilbara is a 12 billion Aussie market cap, and according to Yahoo, has a 6.6 dividend yield. So I think they're somewhat comparable. But for those who think or may think, they missed the Pilbara run, from 12 billion, to 60 billion. If you are another Fortescue, that's another 5 times uplift from here potentially. So I just wanted, could you talk a bit about your background at FMG, before you became the chief operating officer at Pilbara? You also have some history with Chevron and Occidental Petroleum, so you could bring some oil industry perspective here. And and if we could just make some comparisons between iron ore, spodumene, and how you see, these markets similar and different.
Yeah, for sure. No, thanks, Howard. Thanks, Rodney. Great to be back. And it's a bit of a trip down memory lane there, thinking back on my FMG days and really the evolution of iron ore. But just to give the quick snapshot on my history, mixed bag of different resource companies, some oil and gas, LNG, iron ore, and dare I say it, actually a bit of coal out of university way back in the day, which it's almost a bit ashamed to admit these days. I think I'm making up for it now. As to my period with FMG, I enjoyed being part of a tumultuous growth ride there, both the growth ride plus the cost down journey when the iron ore crunch came. So quite senior roles and several chapters there. As to the parallels between FMG and Pilbara's journey, look, firstly flattered by the comparison. FMG's journey's been something quite extraordinary. There are some parallels, I think, in terms of the industry changing significantly. In the case of iron ore, that landscape changed quite significantly. But I think in the case of lithium, even more so, it's just been the emergence of essentially a whole new industry. As you guys appreciate, going back in time, the only hard rock operation globally was, of course, Greenbushes. And then in the last sort of 12 years, we've had a few other operators, the likes of MinRes, Mount Marion, Mount Catlin, Galaxy, whom then, of course, have effectively folded into the LCAM branding. We've had a rapid emergence of the lithium industry. So it's a bit difficult to see where does it all head. My journey with Pilbara started in 2017. So I was in time to see sort of this first uptick around 2018. And then, as you highlighted in your opening, the sort of downturn or lithium winter, as we've characterized it, during 2019, 2020. Saw all of that, and now on the other side of that, and have enjoyed this quite remarkable 18 or so months where we've enjoyed some strong pricing. So it's been a tumultuous a short journey, but Pilbara finds itself in a pretty amazing position. One of the few major raw material supplier for this burgeoning industry. We've got a healthy balance sheet. We've got 5 years of operating experience under the belt, and we've got some pretty exciting growth and expansion plans. So we find ourselves in a pretty good spot.
So Dale, looking at your latest corporate presentation, you've achieved roughly 620,000 tons of spodumene production in 2023, which would suggest that you're getting close or on target for the P680, the initial ramp, and then you've got the P1000 target. Can you sort of give us an update on when and how things are going there?
Yeah, sure. So the P680 expansion project is essentially construction complete. Commissioning's underway this quarter, and next quarter, December quarter, is effectively the ramp up of that incremental step up and expansion. So as we enter the new calendar year, we should be at that new nameplate capacity of 680,000 tons per annum. So that's the P680. As it relates to the P1000, targeting first ore Q3 of FY25. That project is effectively deep into design mode right now. Long lead materials being ordered and all on track effectively. So effectively mid calendar year 25, that should be largely construction complete and heading into a ramp up period.
Okay, great. And I've noticed that you've materially increased your ore reserve to around 210 million tons. I think that equated to, based on the assumptions you had there, about a 34-year mine life. So would it be fair to say that once you get to the P1000, you've got some headroom to expand beyond that?
Yeah, hopefully, Rodney. Fantastic step up in reserve. I mean, we already had an enormous resource and reserve, and to add another 35% was just a massive leap. And because we've got obviously more ore in the ground, we're now turning our mind to that question around what can we do to lift the production capacity even further above the P1000 or the million ton per annum project. So the answer to that is we need to get the studies done. So we're entering study mode now. Once we've done those studies, that'll inform how much larger we can go above P1000. So as to that study timeline, we'll be guiding that actually as part of our next.
Okay, great. Update. And just to finish off on that line, you've still got some drilling or exploration you're doing. So there's still scope to go even further and expand further.
Yeah, we hope so. We've had a fantastic resource and reserve conversion from drilling. The more we drill, the more we seem to find, which is brilliant. So we're going to keep going. John Holmes, our long-standing exploration manager, I've said to him, look, you got 35% this year. What are you going to do next year? He's obviously not expecting that type of uplift, but we'll keep going because it's one of the best ways we can continue to add more value for our shareholders.
Yeah, I mean, I think it's something that sort of people forget. If you look at the incremental, that's what some new projects are hoping for in total. So it is very impressive. Dale, I've seen, there's been some good work and progress on the midstream demo plant side. When are you hoping to have some meaningful output from that demo plant?
Yeah, it's a little way off, Rodney. That project is sort of in engineering procurement mode as we speak. By June quarter next year, we should be into construction. Targeting first production actually by sort of September quarter next year, all going well, and then ramp up to follow. And I suspect that ramp up would be probably around March quarter 25, calendar 25. So essentially from now, it's going to be a year and a half effectively of build, commissioning, and ramp up.
And in terms of the focus, initially a lot of the spodumene is headed, to China. Is the midstream, are you thinking more along the lines of off-takers elsewhere? Is this a sort of ex-China focus when you go midstream?
Yeah, possibly. The way we've thought about midstream, we've thought about it from a very simplistic angle of, gee, there's got to be a better product for market than spodumene concentrate. What can we do to add more value at the resource and bring a better product to market? So the idea of midstream is, of course, do a couple more processing steps at the mine site, stop short of the steps required to take it all the way through to a battery grade product, but in the process materially upgrade the spodumene concentrate to achieve a higher concentrate lithium product, a more sustainable product through more sustainable methods, and through doing that, hopefully, a much more valuable product. Now, if that all goes well, it could be deployed not only to our existing customer set, but we could well go and deploy that to maybe one of the emerging battery hubs elsewhere in the globe. So it's definitely a possibility.
Right. And in terms of where we stand now, I guess we'll have to keep an eye on how many takers there are ex-China for the product everyone wants, but we'll have to see. We'll have to see how that evolves.
To all our viewers watching now, I want to let you know we recorded a long version of this available only to our Patreon subscribers, and we also releasing it, a number of days earlier than for wide release. So just a reminder, if you like this content, please subscribe to our channel, give a like, give a comment. But also, if you want proprietary early access, extended cuts, and other benefits, in some cases, maybe one-on-one access or exclusive webinars, sign up to our Patreon page at the $100 and $300 tiers. And if you just, in general, have been watching us for a little while and have benefited from our content, reach into your pocket for $10 a month, like the cost of 2 cups of coffee a month. Just consider us like your barista at Starbucks, and sign up as a Patreon.
My next question is no doubt Howard's going to touch on again further, but you've got over $3 billion in cash, and you've got a decent free cash flow coming in from spodumene concentrate to cover dividends. So, how much of the cash balance is earmarked, beyond CapEx? What is the possibilities with the balance of that cash? What are you thinking?
Yeah, at this stage, well, we're very much doing our homework around whether there should be any changes to our capital management framework. So we're doing several bits of homework right now, which will come together. And if there's to be a change to the capital management framework, we'll most likely update the market late in the December quarter on that. So until such time, no real changes around how we're thinking about that at this stage. So what that means, as per our capital management framework, we've got a 30% payout ratio tied to a free cash flow metric, with the rest of the proceeds serving effectively the organic growth profile, plus then and allowing provisions to move proceeds to other aspects, which could be share buybacks and organic growth and the like.
So on that line, obviously doing those calculations, one needs to have forecasts and make projections. So the $1 million question, I'm putting you on the spot because I've been struggling to make sense of how things are going. How do you see the state of the spodumene concentrate market?
Yeah, well, I get this question a bit,
I
Rodney,
wish
as
you
I'm
had
sure
the exact
you
answer
and
for
Howard do.
me.
It is, yeah. Look, yeah, it's certainly challenging to get a clear see-through to the fundamentals. And as always, the market keeps us scratching our head somewhat. Um, I'll offer my reflections a little around the long-term outlook, and then I bring it back to more the short-dated outlook of what we see. Long-term outlook, we remain enormously positive around the evolution of this industry and the position Pilbara has within it. We see a long-term structural deficit, which we think is just a fantastic opportunity. And Pilbara Minerals, being early to the party, is positioned incredibly well as a major operator with a low cost base to yield hopefully impressive margins for many years to come, much like what we've enjoyed, particularly over this last 18 months. But being a new industry, it's been volatile. So the question is, well, where to from here? Look, what gives us confidence is first and foremost on the demand side. We view the data everyone else views around EV buying. Those numbers look constructive and positive, albeit within the China market, we haven't seen quite the same compounding growth rates. They've still been very healthy. And then outside of the Chinese market, there's still been some very strong EV growth rates. And then there's mass energy storage as well, which seems to be coming forth and actually surprising some. So demand side looks pretty good. And then as you step through the supply chain, we see effectively no bottlenecks, whether that's the car making, the battery making, the cathode making, the chemical making, and that leaves the supply side. Now, on the supply side, again, we feel fairly positive that supply will be slower. Granted, there's been some supply coming from Africa, and there's been some ramp up on lepidolite. But I think if I bring it back to pricing, the overarching driver we've seen having a bearing on pricing has been what we call sentiment buying, particularly for the Chinese market. We note that the buying behavior can often be sentiment driven versus driven necessarily by stock levels. And historically, what we've seen is when pricing is on a decline side or if sentiment is poor, that gets exacerbated because en masse people don't buy. And then conversely, as the market turns, we see the opposite effect where there can be this mad scramble of buying. And typically speaking, within the Chinese market, most contracts are very short dated, which sort of exacerbates this quick response to those shifts in sentiment moods.
Can I just interject to follow up on that, Rodney? You say sentiment driven buying. Okay, they're pulling back. They're holding low inventory levels. How do you assess those inventory levels and when the pullback from the buying stops and then the panic sets in? When the price starts going up again.
Yeah, well, I think when we look at the supply side and you sum through those supply sources, and the ones you list are all publicly available, and you add the other suppliers which are maybe a bit more challenging to get a read on, but you make some assessments around that, and then so we of course do a sort of a stack sum of that, and then we cast our mind to, well, what's the demand side doing? And where's demand heading? And I think the key piece of the equation here is which outpaces which. Does demand outpace supply, or does supply outpace demand? And it's hard not to see supply struggle to meet the demand when you look at some of these compounding growth rates we've seen in EVs. Supply is just, and you guys appreciate this, it's just slow to come to market as a function of the challenge of bringing these natural resource projects online. More money does not equal necessarily a quicker project. It helps, but the development of these mines just takes time, and hence we think Pilbara's got this opportunity to really exploit as demand continues to ratchet up. We should be able to ratchet up supply quicker than others, and if we can enjoy the periods like we've just had, well, there should be some fantastic periods of high margins to enjoy for our shareholders.
Thanks for that, Dale. In terms of ex-China conversion capacity, what is Pilbara's thinking about how quickly ex-China conversion can come online? Everyone wants it. Everyone wants closed loop supply chains, but is the reality going to tie in with a lot of battery cell announcements, plants, but where are we going to see, aside cathodes, another thing, but conversion capacity for battery grade chemicals outside of China? How do you see that landscape?
Yeah, I think it's I think that the jury's not out on where the long-term battery materials hubs for the globe will reside. I mean, China has been, to their credit, the home of the lithium-ion supply chain. That they've built every aspect of it, and of course, they've attained global dominance at this point. So then everyone's asking, well, where are they going to be the new battery hubs globally? So the jury's not out. Our view is that South Korea, I think, stands a really good chance given it's got an existing battery materials hub. We think the cost base is pretty good, and we see some really progressive steps happening in that space. And of course, our joint venture with POSCO sort of speaks to our belief in that domicile as an emerging hub.
Jumping in here from the editing room to tell you about our two sponsors, Zelandez and Lithium Royalty Corp. Zelandez provides services in subsurface data visualization, downhole geophysics, and other services for lithium brine operations. They just expanded into North America, and no matter where you sit in the brine industry, Zelandez can help you speed up and improve your projects. Go to zelandez.com for more. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LARC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com.
The last question from me, Dale, is, I guess this is an important one as you analyze and look across, upstream and downstream. Do you see the margin split remaining in favor of miners for the foreseeable to, midterm, or do you see will the downstream, the midstream and the chemical converters start to see their margins improve relative to the miners?
Yeah, I think whilst raw materials is the supply constraint, I think the lion's share of the margin will continue to reside with the raw material supplier, which of course is great for a group like Pilbara. But I'll just add, that does not mean that there won't be some healthy margins to make in the chemical conversion, particularly for those competent chemical converters whom are achieving the right quality requirements and selling their products into the markets which appreciate those quality requirements. And further, if those markets are able to access the IRA or other support benefits, there could be some healthy margin, in our view, in chemical conversion.
Okay, I want to go back. If I recall correctly, your long-term spodumene concentrate price is $14.50. Is that right?
That's what we've used for our reserve calc. Correct. Yeah.
Oh, okay. And
which is typically most groups choose a fairly conservative value.
When you think about your capital management, as you said, you're going to regroup in December. What informed your shorter term forecast?
Well, yeah, you got to take a view on the supply demand balance, and it's hard to see, yeah, chemicals dropping below, say, 20,000 US, and we hear from some of the Chinese counterparties talking about, say, 200,000 RMB being a floor, effectively. This is some of the opinions we hear, and that's quite a different view of the floor that we had a few years back. So we take a lot of comfort from what we hear around that. But yeah, I wouldn't hazard a guess on exactly where the midterm pricing will go, because undoubtedly we'll get it wrong.
Right. Okay. I, and prices are higher, but inflation is very evident. And I remember the first feasibility studies for Pilbara, where the forecasted cash costs would be, I think, 250, right? US. What are your current costs now? Operating costs?
I think we guided in the range of 600 to 690 per ton. Sorry, 600 to 670 per ton. FOB per dry metric ton for FY24. So it's definitely moved north from historically what we were looking to achieve.
Going back to our comparison to iron ore, I remember Fortescue, when I first was looking at it 20 years ago, they were forecasting price to be like their cost to be, I don't know, $40 or $50, right? And and if the price of iron ore was 100 or 150, as it was, they'd make a lot of money, but their costs have gone down enormously. I think they were, between, I don't know, 15, 12, 15, $20. So can you see that happening in lithium and spodumene production? What contributed to all those cost savings at Fortescue? And is it applicable for Pilbara or others in the industry?
Yeah, I think there's definitely opportunity to continue to reduce the cost base, and uh, looking at our particular asset, we've got quite a number of cost down initiatives. We're either progressing or have our eye on for the future, and that ranges from a different power solution to haulage, we currently use triples, moving from triples to quads. If I think about our port outloading, we use retainer boxes, which are to load the vessels. We're in discussions with the Pilbara Ports Authority about direct outloading facilities, so conveyors, ship loader, and then there's outright recovery improvements at the mine site. Now, do I see a world where our cost of production halves, to the example you mentioned around FMG? I think that's highly unlikely. But do I see lots more incremental cost out over the years to come? Yes, I do.
If we could start, firstly, I guess you as another partner, as a target, the status of your process, of auctioning, the 300,000 tons of spodumene. I think there was, there was a first pass. You talked about having like 70 interested parties, and that you would narrow that to some kind of short list. So, could you talk to the nature of the potential partners, China versus non-China, big auto, big battery, big mining, big chemical, big oil? Are they all in the mix? Are some more prevalent than others? And do you have an inclination for or against any of those as partners?
Sure. Yeah. The offer to market, as you say, was 300,000 tons of spodumene, and for that we quite purposely went to market with quite an open offer. We just said 300,000 tons of spodumene for the purpose of a joint venture. As to what that joint venture is, we're open to all ideas. That was the offer to market. As to the level of inquiry coming back, as you'd imagine, it was pretty significant. 70 plus credible groups interested, and we've moved forward with a process where we've been working with a smaller subset of that total group. What's the composition of that group? there's some real diversity in that. But of course, our core customers are part of that, as you'd expect. There are chemical converters, there are OEMs, and there's some other groups whom don't fit into those particular buckets I just described. So there is a spectrum of different groups. And these commitments and these types of joint ventures, they're multi-decade commitments, as we did with POSCO. And we've only got so much ore in the ground, so we've got to get these decisions right and make sure that if we are to sign away that 300,000 tons, it's for the right deal, and we're getting the best deal possible for our shareholders. So early in the process, plenty more work to be done. We've guided that we'll be updating the market on the process in the March quarter. Now until then, lots of work effectively in the process, maturing those opportunities.
Okay. And so you have the beachhead with POSCO in Korea. Is it important that you have another beachhead in Europe or North America, or it just depends on the deal?
Depends on the deal, definitely. As a general principle, as a business, we've always liked the idea of diversification because that makes good business sense. So we always had this idea that we wanted to not be completely have all our eggs effectively in the China basket. And the POSCO deal, where we sort of signed up the bones of that in early 2018, was largely about that type of diversification. Fast forward to today, the thing we've got to weigh up is that question that piece we talked about earlier around, well, what is the confidence around these new battery hub domiciles elsewhere in the world? When are they going to be emerging? What's the risks around participating in that versus the opportunity of concentrating in either South Korea or China? So we haven't taken a view on all of that, but obviously we'll have to as we progress evaluating these different options. And it's just a function of where the industry's at. There's quite a spectrum of different maturity levels as we all observe the industry evolving.
Okay, very helpful. And now I want to talk about just overall M&A because there's a lot happening in Western Australia, and you're seeing MinRes, you're seeing Hancock, you're seeing IGO's name, Albemarle with Liontown, and also in Patriot, SQM, but you haven't seen Pilbara's name. You've seen it rumored, but you haven't seen Pilbara either taking minority stakes like MinRes has or on market buying like Albemarle and Hancock and MinRes have done. So, why not?
We've been pretty boring, haven't we, Howard, compared to some of our peers? And I guess the key reason behind that is we've genuinely not wanted to take our eye off the ball. We're a company whom physically effectively doubled last year. In every respect, we almost we had a 60% lift in our construction, huge leap. 50% lift in our production capacity this year past, huge leap in terms of our employee count. We did our first dividends, our first capital management plan, you name it. Lots of sort of growing pains as we're quickly growing as a business. So we've kept our efforts and internally very much focused on that. But meanwhile, we have started to build out that BD capacity within the business. And that, of course, started with the appointment of John Stanning as our Chief Development Officer. So he's he must be about 7 months into the role now. So in that time, very much building his team and starting to help us think through what inorganic might look like for us. And of course, we'll start to look at stuff as these opportunities come along, but we're certainly in no rush. And the reason is we don't want to take our eye off the ball. As you alluded to earlier, mining has a long history of groups rushing transactions through and regretting them later. We don't want to add to that storybook. However, we do want to be prepared and ready such that when the right opportunity comes along, we are positioned to transact and capitalize on it. And let's not forget, Pilbara has had some history, and Altura was an acquisition.
It was an amazing acquisition.
It
It was a legendary acquisition.
Yeah, competitive process, and we were successful in getting the job done, and that's worked out very well. So we'd love to pull that off again. I'm not sure if that opportunity will ever present.
I think as good an opportunity as that was, buying something at virtual replacement cost that was in production, I don't know that you'll get as good an opportunity as that. But if you do M&A, are you thinking kind of early stage exploration, like, Albemarle and Patriot, or later stage? So just in terms of proximity to production, do you have any preference? And then I'm going to ask you, like, how much does size matter, like resource size?
Yeah, we haven't ruled out any of those sort of categories: explorer versus developer versus producer. I think Pilbara would have an appetite to consider each of those categories. It's more around the specifics of the project. Of course, the Altura acquisition, that was an operating asset. Historically, Pilbara has looked at ground, and it's a low cost entry, but of course longer gestation. And then the developer category, it comes with some risks, but potentially Pilbara can help de-risk some of those risks. So each category has got some pluses and minuses, and some reasons why you would participate. I think we've got an open mind to all of them. It's as I say, it's more around the specifics of the particular project in question.
Very helpful. I listened as well to all the MinRes presentations, and it struck me that Chris Ellison commented that he looked very seriously at doing something in Brazil, I think from a mine services point of view, but fundamentally couldn't get comfortable from a jurisdiction perspective there. And he also pulled out of, the joint venture where he would have invested $1 billion in China. So would you consider South America or African spodumene assets as part of the M&A, or are these locations too risky and you'd more focus on, I think you mentioned tier 1 jurisdictions the last time we spoke last year, like Canada or Western Australia?
Yeah, a strong bias would be towards the tier 1 jurisdictions. And we're conscious that, our investors tell us that they really like Pilbara's offer to market, tier 1 asset, tier 1 jurisdiction with strong operating performance. So we wouldn't want to do something which dilutes that offering. And I think if we were to step into one of those other parts of the globe, it probably would be perceived as dilutionary, introducing risk and taking away from the offer Pilbara has. That would be, the bias that we have.
I mean, you share any thoughts you have on Canada spodumene, Quebec versus Ontario versus other provinces as you've looked at the opportunities?
Yeah, no, we watched the area with interest, Howard, from afar, and no strong bias to any of the particular regions that you mentioned. And I'd be loath to pick one out because chances are I know an executive or two who's pushing a project in that area, and they will call me up and have a go at me if I pick it. If I pick a favorite. So I won't. I'll avoid that phone call. But yeah, look, I think what's exciting is the world needs plenty of lithium, and some of this ground in North America looks great. And I watch the debates with interest around timelines for delivery and the expertise required to bring these to market, et cetera, et cetera. There's some heavy lifting to be done, but there's good potential, and there's some really willing, smart people looking to give it a red hot crack, and it should all come to market in time, I'm sure. How much time, I don't know, but we'll watch with interest.
Okay, but any thoughts on tapping the bond market in any way in the next year or so?
Unlikely in the near term, Howard. I think we've got a strong balance sheet. There's no need to tap into any of those markets at this time. So it's not on the to-do list in the short term.
Any comment on the economy we're seeing in valuations paid by strategics versus what the market is showing us with, good, decent companies, even in production, being hit substantially?
Yeah, no, there's definitely, when you step back and you look at the full spectrum of valuations, you do sort of scratch your head a bit when you look at what's occurring out there. And that's with not reference to any particular project. There is some real disparity. But to be honest, I don't think too much about it. I subscribe to the sort of the Warren Buffett analogies of, long term, the market, the scales are a long term weighing machine for value, and we just keep focused on getting on with the job. We'll continue to expand, continue to be that reliable producer at a low operating cost base. And in this volatile market, which sort of swings from lows to highs, as those highs return, and all going well, that happens soonish, well, we're going to continue to print these amazing returns. And the margins Pilbara can produce, you just can't ignore that. So it seems pretty likely that the market will rightly, re-rate Pilbara over time as a function of value creation and delivery.
That's great. To your point about long-term value and going back to what we started at the beginning here, Fortescue is a 60 billion plus company. You're a 12 billion plus company. So stay along for a 5 to 7 year ride. If that's in store, a 5 times uplift, that's a pretty good weighing machine for a company which has a world-class, very large and growing single asset company, for the most part, in Western Australia, with very good customers, very good partners, and very good strategy, with an incredible balance sheet. So it's a great story, and we thank you very much for taking the time to update us, Dale, and look forward to the strategic process in the March quarter, your capital allocation update, and John, your business development guy. Maybe you'll be on the tape with some interesting M&A sometime before we speak next. Thanks again.
Thanks, Dale.
Thanks, Howard, Roddy. Really enjoyed it.